Welcome, fabulous ladies, to Rich Girl Shift, the place where we transform how women see money and build the dazzling financial future they deserve. Today, we're diving into an incredibly exciting topic: how to start investing in 2025, even if you feel like your wallet is giving you the silent treatment or you think investing is a game only for the super rich. If you're living paycheck to paycheck, or if investing sounds like something out of reach because you've never done it or your family never talked about it, this video was made just for you. The truth is, wealthy women have been investing for centuries. It's how they create and sustain their wealth. And the best news? You don't need thousands of dollars to get started. In this video, I'm sharing 10 powerful secrets to kickstart your investing journey, no matter where you're beginning. If you're new here, I'm your financial empowerment guide, a certified expert, and I'm passionate about helping women like you shift from financial stress to shining success. My mission is to help you master your money so you can live confidently and boldly. If you're ready to change how you think about money and start building wealth, hit that subscribe button, drop a like, and share this video with a sister, friend, or any woman you want to see thrive. Before we dive in, I need to clarify one thing. This video is for educational purposes only, not financial advice. I don't know the specifics of your financial situation, goals, or risk tolerance, so always do your own research and consult a financial professional before making big decisions. Now, let's jump into these 10 secrets to becoming a confident investor. The first thing we need to understand is why so many women don't start investing, and the reason might surprise you. The biggest barrier isn't how much money you make, it's how you think about money. Many of us believe investing is only for the wealthy, as if you need a luxury penthouse or an overflowing bank account to even get started. But that's a huge misconception. Many wealthy women achieved prosperity by consistently investing small amounts over a long period. They didn't wake up one day as millionaires. This misconception often stems from what I call money stories we tell ourselves, like "I don't have enough money to invest," "investing is for rich people," or "you need money to make money." But here's the truth. Wealthy people built their fortunes by investing a small portion of each paycheck, regularly, and letting time work its magic. The secret lies in compound interest, something almost miraculous. Albert Einstein is said to have called compound interest the eighth wonder of the world, and he was onto something. When your money starts earning returns, you earn returns on both your original amount and the returns you've already accumulated, and over time, your wealth grows exponentially. Picture this. If you invest just $5 a day with an average 10% annual return, roughly the historical average of the U.S. stock market, you'd have over $1 million in 42 years. Just $5 a day. Imagine what you could achieve if you invested $10, $20, or even $50 a day. Even if you can only start with $1 a day, set a goal to increase that amount over time. The longer your money works in the market, the wealthier you'll become. So, don't wait another second. Become an investor today. The earlier you start, the brighter your future will be. And if you're starting later? No worries, beginning now can still make a huge difference, whether you have 5, 10, or 15 years to invest. Next, we need to talk about overcoming the fear of investing. Are you worried about losing money in the stock market? If so, you're not alone, girl. That fear is common, and it's holding too many women back from building wealth. Our brains are wired to fear loss more than to crave gains. Psychologists call this loss aversion. If you've ever thought, "What if I invest and the market crashes?" you're in good company. But history proves that the stock market trends upward over time, despite periodic sharp declines. The key is understanding your risk tolerance and committing to a long-term strategy. Think of investing like planting seeds in a garden. You don't plant seeds today and expect a fruit tree tomorrow. And if you keep digging up those seeds to check on them, they'll never grow. Investing works the same way. It's a long-term journey. Long-term growth always outshines short-term fear. Look at the 2008 financial crisis or the dot-com bust in 2000. Many people panicked, sold their investments, and later regretted it. Those who held steady not only recovered but often saw their portfolios grow stronger. And those who bought during the dip? They seized a golden opportunity. A fantastic way to start investing without too much worry is to explore target date funds. These are perfect for investors who want a hands-off approach, as they automatically adjust to reduce risk as you age. We'll dive deeper into these funds later, so keep watching. Now, let's talk about building a rock-solid financial foundation. If you're investing without doing this, you're setting yourself up for trouble. Imagine building your dream home on unstable ground. No matter how beautiful the house, it'll collapse if the foundation isn't strong. Your finances are the same. Before you jump into investing, you need a sturdy financial base. First, create an emergency fund with enough cash to cover 3 to 6 months of living expenses. Ask yourself, if you lost your job tomorrow, how long could you keep things together without panicking? An emergency fund isn't just a smart financial move, it's peace of mind. Without it, an unexpected expense could force you to sell investments, possibly during a market dip, locking in losses. Second, tackle high-interest debt, like credit card debt. Would you borrow money at 25% interest to invest for an 8% return? Of course not. But that's exactly what you're doing if you're carrying credit card debt while investing. I recommend focusing on paying off high-interest debt, but don't wait until you're debt-free to start investing. Allocate a small portion of your income, like 1%, to investing and a larger portion to debt repayment. Once that credit card debt is gone, you can boost your investing. Don't fall into the trap of waiting to be debt-free before investing, as many people will always have some debt, like student loans or a mortgage. Start small now and adjust over time. Finally, if your employer offers a 401k with a matching contribution, take advantage of it. It's free money, like doubling your investment instantly. Building this foundation is the first step to ensuring long-term financial success. Think you need thousands of dollars to start investing? Think again. You only need $5, less than a coffee or a fast food meal. Thanks to fractional shares, you can buy a small piece of a stock instead of a whole share. It's like grabbing a slice of pizza instead of the whole pie. Today, investing isn't just for those with big bank accounts. Modern platforms let you start with tiny amounts. If you invest $5 or $10 a week, that money will grow significantly over time. With such a low barrier, there's no excuse to delay. Start today, your future wealth is waiting. Next, we need to discuss choosing between index funds and individual stocks. This is a critical decision, as the wrong choice could cost you dearly. Imagine betting your entire savings on one company. Would you do it? Probably not. Companies can fail, and that's a huge risk. But what if you could spread your money across 500 companies? That feels much safer, right? That's the power of diversification, and it's why index funds are a smarter choice for most women. Index funds, like those tracking the S&P 500, let you invest in hundreds of companies at once, reducing risk significantly. Did you know that 95% of Wall Street pros can't outperform index funds over the long term? If the experts can't do it, why think you can? Don't try. Individual stocks carry higher risk. If a company goes bankrupt, your portfolio could take a big hit. If you want to dabble in individual stocks, treat it like play money, cash you're okay losing. For steady, long-term growth, index funds are the safer bet. This is where target date funds come in handy. They're typically a mix of index funds, offering broad diversification across global stocks, bonds, and sometimes real estate. You simply pick a target year, like when you plan to retire, and the fund automatically shifts to lower-risk investments as you approach that date. These are great for beginners and seasoned investors who want a low-maintenance, diversified portfolio. Research them thoroughly. They're a perfect starting point. The next secret is automating your investments, the most powerful way to build wealth without overthinking it. How many times have you planned to save money but ended up spending it on something unexpected? Life gets in the way, and that's why automation is a game changer. Dollar cost averaging is the strategy of investing a fixed amount regularly, like monthly from your paycheck. When the market's down, you buy more shares. When it's up, you buy fewer. This removes the temptation to time the market, something experts advise against. Automation isn't just for retirement accounts like your 401k. You can use it for other goals, like setting up separate savings accounts for vacations, a new car, or holiday gifts. Automatically transfer money from your main account to these accounts each month, and over time, these small contributions will turn into substantial wealth. Build your empire on autopilot. It's the easiest way to stay on track and avoid spending money you meant to save. Investing can feel risky, but not investing is even riskier. What's worse, watching your investments fluctuate with the market or keeping your money in a savings account where it's guaranteed to lose value due to inflation. Inflation is the silent wealth destroyer. If your savings earn just 0.5% interest while inflation rises 3% a year, you're losing purchasing power. Meanwhile, the U.S. stock market has averaged over 10% annual returns. That's why wealthy women invest, to grow their money and outpace inflation. The key is managing risk through diversification. Don't put all your money in one place. Spread it across different asset classes, stocks, bonds, real estate, and different companies, from small to large, domestic to international. This is why target date funds are so popular. They handle diversification for you, making investing less daunting. Want to keep more of your money while building wealth? Pay attention to the type of investment account you use. It has a big impact on your taxes. Some accounts let you invest with pre-tax dollars, reducing your taxable income now. Others let you pay taxes up front and enjoy tax-free growth later. If you want to lower your taxes this year, look into 401k, or traditional IRAs. These allow you to invest pre-tax, lowering your tax bill now, though you'll pay taxes when you withdraw the money later, possibly at a lower tax rate. If you want tax-free growth later, consider a Roth IRA. With a Roth IRA, you pay taxes up front, invest, and when you withdraw the money after 20 or 30 years, you owe no taxes on the gains. Research these options carefully and consult an expert if needed, as the choice depends on your personal financial situation. The market will crash. It's not a question of if but when. But here's the good news. Every crash in history has been followed by a recovery, and markets often reach new highs. The worst thing you can do is panic and sell during a downturn or take big risks when the market's at a peak. That's emotional investing, and it's why most people lose money. We're wired to buy high when we're excited and sell low when we're scared, the exact opposite of what works. You can't predict the perfect time to buy or sell, so don't try to time the market. Instead, focus on the long term. Right now, while the market's stable, imagine how you'd react if it dropped 20%, 30%, or 40%. If that scares you, consider a more conservative portfolio. Investors who stick to their plan through downturns usually come out ahead. And if you're young, a market crash is your golden ticket to buy shares at bargain prices, setting you up for bigger gains when the market rebounds. Keep investing regularly, and you'll thank yourself later. Finally, the fastest way to build wealth is to invest more. Too many women set their investment contributions and forget to increase them. Automation is great, but you need to find ways to invest more each month or year. Got a raise? Invest the extra income. Received a bonus or side hustle cash? Put it to work in the market. Cut back on expenses? Invest the savings. Check your progress regularly, but don't obsess over daily market swings. Those fluctuations can feel like a roller coaster, but zoom out to a weekly, monthly, or yearly view, and it looks like a steady path to wealth. Investing is a marathon, not a sprint. Don't fall for get-rich-quick schemes. They're a fast track to losing money. Ladies, I don't know your specific financial situation, so I'm not recommending any particular investments. Always consult a financial advisor for personalized advice. If you found these secrets helpful, give this video a big thumbs up, subscribe to Rich Girl Shift, and share it with a woman you want to see shine. I want to hear from you. What's holding you back from investing? Drop a comment below and let's chat. Most importantly, take action today. Don't wait for the perfect moment. The best time to invest is now. Join the Rich Girl community, keep learning, and let's build wealth together. I'll see you in the next video. Stay fabulous and keep shifting to riches.